Hi, good afternoon and welcome to Trading Hour. I'm Sumera Abdi and with me is my colleague Reema Tendulkar, and we begin today's show with the mutual fund data that has just come out. So it's for the equity schemes, it's an inflow of close to about 15,500 odd crores. But on the debt side, there's quite a big number for an outflow. So it's more than 92,000 crores that have flown out, and most of that money is actually leaving from the very, very near-term category. So overnight, liquid, ultra short-term funds, as well as low duration money market. These are the big culprits. Even corporate bond fund, for that matter, has seen an over 9,000 crore rupees in terms of an outflow. Back to the equity side, what's doing well? Well, large cap funds continue to see money coming in, but we have seen so much volatility in our own markets that perhaps it's the safety of the large caps that investors are sort of opting for. Amount coming in for large and mid cap and small cap funds also are doing quite well. In fact, 1,600, 1,800 crores coming in on both of those. So again, those two categories continue to do well, and flexi cap again remains a favorite with 2,500 crores coming in this month. Surprisingly, hybrid funds as a whole have seen a net outflow of about 2,300 odd crores, primarily from the arbitrage account, and it's another very, very strong month for passives with 13,000 crores roughly coming in. Mr. D.P. Singh, who's a Deputy Managing Director and Chief Business Officer at SBI Mutual Fund, joins in now. Hi, Mr. Singh. Thanks very much for speaking with us. On the equity side, it's looking good. I'm just curious why, hybrid funds are not attracting the same kind of money that they were attracting earlier, considering that volatility still rules.
Yeah, Sumera, thank you very much for having me. And see, as far as your question on hybrid is concerned, the basic reason is that the short-term funds like liquid and overnight funds, the returns have gone up, the yields have gone up. So arbitrage fund, which falls under the passive category and this hybrid category, so those are less attractive now. Earlier, these funds were getting a return of around 4.5%, whereas the overnight and liquid funds are giving a return of 3.5%. But over the period when yields have gone up, the people have moved their short-term money, which they were parking in arbitrage funds, to these kind of funds now, to the liquid and overnight category.
But sir, from overnight all the way to that 1 year bucket of money market, all of them are seeing outflows.
No, that is because of the June end phenomena.
Okay.
See, overall, the money which has gone out from arbitrage has gone into these funds, and in quarter end, generally you will see the outflow. All the institutional players, they withdraw money. The withdrawal is not because of any other reason, but because of that. But if you will see after 30th June, again the money has flown back into the industry.
Okay. And by the way, I must add that this 15,500 almost of money that has flown into equity funds is minus any NFO. You'd remember that in June, there was a SEBI ban on launching any new schemes. So this is basically money that is coming into existing schemes. Mr. Singh, you expect this trend to continue despite the swings in the market?
Yeah. So we have to keep in mind that we have around 13,000 crore of SIP book. And when the markets are down, see very mature behavior which we have seen from the investors. They have not stopped their SIPs. Rather, the SIPs have gone up. More and more number of people have registered more SIPs. So out of 15,000 crore, even if 75% triggered amount has come, the net flow actually is 3,000-4,000 crores, 3,000 to 4,000 crores only out of 15,000 crores.
Okay.
So that's the way we have to look at it.
Okay, that's a fair point. So on the debt funds, on the funds which are primarily credit oriented, right? Corporate bond fund, credit risk fund, banking and PSU funds, all of these continue to see outflows. I mean, is this again, would you say this is just a June end phenomena, or is there really some worry that may be surfacing regarding credit?
Because as far as retail is concerned, they had put in money with some target amount in mind. So the people were looking at the negative returns or very, very, less returns in 3%, 2%, 4%. In some cases, negative returns also because of the yields moving up. That's why people are moving out of these and the money is flowing into the target maturity funds, which is all down strategy, which has become very attractive. When we are saying that passives have seen an inflow of 15,000 crores, that
13,000, sir.
includes the debt index fund also.
Right.
That is not the only equity ETFs, etc. The index funds also, which are in the debt category, those are also in these numbers itself.
All right, Mr. Singh, thank you very much for joining in and for giving us your quick take on this. Also, by the way, the assets under management for the industry now stand at 35.6